Hello, everyone. Happy Friday. Welcome to the second in a series of free Together San Diego business webinars. I'm Luis Cruz, Community and Public Relations Director at the San Diego Union-Tribune. This morning, we'll be reviewing the historic first half of 2020, and we'll learn what the economy and financial markets may bring over the second half of 2020. Anthony Valeri from California Bank and Trust will also assess the disconnect between the economy and the stock market, the reopening of local and global economies, the risk of a second wave of COVID-19, and the potential implications for the November 2020 elections. Anthony Valeri is an investment management director for wealth and fiduciary services at California Bank and Trust. He is a chartered financial analyst who works with clients to help them understand complex financial strategies and market dynamics. He has more than 25 years of experience in wealth management and financial services and is regularly quoted by large media organizations. Anthony will give us his presentation and then we'll allow another 15 minutes or so for questions. You can put your questions in the Q&A box right on the right-hand side, lower right-hand side there of your screen. And we are recording this webinar so we can provide it to you later as well. Anthony, welcome this morning. Why don't you go ahead and take it away?
All right, good morning and thanks for having me on and thanks for joining everyone. Hope to share our thoughts at California Bank and Trust and our wealth management group on what we see in financial markets and the economy. Allow me a second here just to share my screen and we'll get started here. So I'll take about 25-30 minutes to talk about the latest in the economy and financial markets, what the future may hold. And then, of course, as Luis mentioned, we'll open it up to questions afterwards. So here's our view on markets and the economy. I'm going to start with a summary first to reiterate that the U.S. economy bottomed in April and activity globally, not just here in the U.S., is improving. And there's another number of metrics we're watching in that regard. Global stock markets have bounced back strongly since the March lows, but there will be bouts of volatility. We're in the middle of one right now. I think that's likely to persist for some time. The Federal Reserve has been very market friendly and reiterated their lower for longer message. And finally, a resurgence in the virus is unlikely to result in the widespread lockdowns witnessed in March and April, but could still slow the recovery. And we're seeing signs of that now as there are some partial rollbacks or reopenings given this latest resurgence in the virus, and I'll talk about that as well. So those are the points we'll cover here today. And starting with the economy, there's a number of metrics showing how the economic activity has picked up. I'll start with what we follow closely, the Economic Surprise Index. This index is a measure that captures how much economic reports in the US, and there are versions globally, captures how much of those economic reports are exceeding or falling short of forecasts. And you can see that this line has sharply bounced back, showing that a preponderance of economic data has exceeded expectations. Now, to be true, the bar was set pretty low following that steep drop, which you can also see there. You can see the peak in early 2020, subsequent decline, and then bounce back. But this does do a good job of summarizing the degree to which recent economic reports have sort of exceeded forecasts and basically confirm that bottom in the economy occurred in April, and since then there has been gradual improvement. There's other metrics that we can follow to track that improvement, and a number of kind of what I would consider alternative data measures, and I'll get into more of those, but lots of ways to check on a week-to-week basis how is the economy reopening. One is air travel, and it is still very depressed, down 80% from what would be a normal level. But if you look on that in the bottom left, you can see how it has slowly improved since April. And it looks as though that is continuing to improve. This is probably obviously one of the hardest hit areas is travel, but to see some improvement there off the low is an encouraging sign, and would expect that to gradually improve from here. Housing market also took a hit in April, but there where the benefit of lower interest rates is really starting to come through, and you're starting to see a pretty strong bounce back in residential real estate, uh, primarily in mortgage applications, but you're seeing a lot more activity on purchases as well. You're going to see improvement from that as well going forward. Existing home sales was released recently, but that data point, at least for May, covers closings. So the May report actually covered activity in April. Would look at that as more a sign of April data, and we'll see more improvement there as well. In terms of the labor market, this is one area where there was some modest improvement early to mid-May, which was a sign that people were getting back to work. This is weekly jobless claims and specifically continuing claims. And in early May, continuing claims dropped by almost 5 million, but they have still held relatively steady at 20 million. Yesterday, the latest version of this report was released and showed that 19.5 million people remain unemployed. So since that initial drop, which really reflected so a lot of people going back to work, there hasn't been much more improvement since then. So really seeing some stagnation in the labor market. It's important that this continues to improve, but it also shows you that this recovery is going to take time and therefore to be patient. And as that takes time, that does leave the stock market vulnerable to periodic corrections and bouts of volatility. So more improvement needed in the labor market. Where you're also seeing a stall is in U.S. restaurant activity. Again, this is one of the alternative data measures that we've taken an increased look at as a result of the coronavirus. Open Table provides data on the percentage of people that dine in at a restaurant, and you can see the year-over-year change here, down almost 70%. You can see that from early May through mid-June, there was steady improvement, but as virus cases have picked up recently, that activity has stalled. So it's important to note that as the virus picks up, that could interfere with the economic recovery. But again, one of the leading data points that we are tracking to show how does this economy recover and ultimately benefit financial markets. So a little bit of a stall recently. We think that's normal. This bears watching, but again, the initial signs to show that the bottom, what occurred in April, are still there. One of the strongest data points regarding the economy is with the consumer, and total retail sales in May bounced back sharply. This is sort of looks a lot like the V-shaped recovery you often hear about in the media. But again, a real strong bounce back in May. This report was stronger than expected, and it really showed a couple things. One, a lot of the stimulus from the government is helping to support consumers. I think that's very important. But also consumers were willing that in fairly good financial health to can resume activity. So this is probably one of the better signals you've seen from the economy. It did cause economists to revise upward forecasts for second quarter economic growth, which is still going to be terrible, no doubt about it, but still not as bad as previously feared. And then third quarter economic expectations or economic growth expectations, where a strong bounce back is expected, were lifted higher as a result of this report. So this is probably the most positive sign we've seen from an economic recovery standpoint. More to go, but again, one more data piece to show the recovery. And I would be remiss without talking about the response from central banks around the world and also governments. It's the response from governments around the world from central banks is roughly double what we saw following the great financial crisis in 2008. And it's very important to realize just how aggressive they have been. This chart here shows the fiscal stimulus, in other words, government spending as a percentage of GDP or size of their economy. And you can see the magnitude of what's been done in Japan, in the Eurozone, in the US, Canada, and also China. So a very aggressive response from governments in terms of spending. And I don't think this is over. In the US, we are talking about a fourth round of stimulus that will likely be debated in Congress in July. Would not be surprised to see an additional government spending package approved by the end of July. And even here in June, the Bank of England increased their bond purchase program. That's not reflected on this chart here. You're just seeing additional stimulus around the globe. And so central governments around the world continue to have their foot on the gas to try to stimulate local economies. So an impressive response, and that's really helped soften the impact of the virus pandemic on on an economic basis getting much worse. if you look at central banks, and here I've got the four largest central banks, so the Federal Reserve, Bank of Japan, People's Bank of China, and the European Central Bank, they've all responded with various spending measures. In the U.S., the Fed has announced an aggressive bond purchase program. So as the European Central Bank, and what you're seeing is a very big increase in central bank balance sheets, and you can see the acceleration from early 2020. They've added almost $5 trillion to their balance sheet. So an aggressive response. And just to put it in perspective, the U.S. Fed completed the equivalent of their first round of bond purchases post 2008 in about 10 days in early April. So just to show you how quickly and aggressively they acted this time around. And that was a key support for financial markets and government spending, along with what the Fed has done and these central banks around the world. Again, a key support. And it's actually a big reason why we do not think the stock market is going to revisit the lows in early March. Well, let's shift gears and talk about the stock market. You're hearing a lot of talk in the media about the stock market being expensive, and it is. If you use traditional PE ratios, price to earnings metrics, this shows the forward PE, the gold line, which is using an expectation of this year's profits, and then trailing PE, the black line, which shows profits over the trailing 4 months. The higher the PE ratio, the more expensive stocks are, and vice versa. You can see that both of those metrics are on the high end of a 13-year range here. I will say you should take these with a grain of salt. These are 1-year look back or look forward measures. But remember, if you're an investor, you really should be buying stocks with a 3, 5, 10-year horizon. And when you consider the growth in corporate profits or corporate earnings over that 3, 5-year span, stocks are nowhere near as overvalued as this chart might suggest. And investors to some degree are throwing 2020 out the window. And I think that's an important distinction. They know 2020 is going to be bad, and therefore, what does 2021 look like? What does 2022 look like? And that's really what's going to drive, I think, the market from here. So a lot of noise around short-term valuation metrics. Again, I think if you look longer term is the correct way to value it. And on that metric, I think the market is slightly overvalued. But again, I don't see it being grossly overvalued like you may hear in some of the media stories. Now, on a broader basis, you have to consider investing in terms of the overall landscape. And relative to bonds, stocks are attractive. The percentage of S&P 500 stocks with dividend yields greater than the U.S. 10-year Treasury yield is its highest ever. 71% of stocks in the S&P 500 now offer a dividend yield higher than the 10-year Treasury yield. So, what's one metric to show that stocks are more attractive relative to bonds? So, if you're an investor, you should still keep your weighting in equities. And the other part to take in mind to consider, and this is more proof on why we don't think the market is going, or stock market is going to revisit the lows of March 23, is the breadth of gains is a very positive signal. So one way to measure the recovery in the stock market is how many stocks are moving higher. If it's a narrow group, then that's not a good sign of the health of the stock market. But if it's broad and there is broad participation, then that is a very good sign for the future in the equity market. And in early June, there was a big surge in new highs. One way to measure that is tracking when more than 65% of the S&P 500 index is making a new 20-day high. And that hasn't happened very often. You can see that list here. And at the bottom is where we tracked it this time, June 5th, that hit that metric. And these are whenever it went over 65%. And then we track the performance over subsequent 1, 3, 6, and 12-month periods. And what you'll find is when you go to the bottom and look at the average data, over the following 1 month, when you've had these surges in positive breadth, the market's actually consolidated and the average return is negative. Over the next 3 months, the returns was not bad, 3.6% on average. However, only 63% were positive. So not a great batting average in terms of trying to get a good result as an investor. But when you move out further, and specifically looking at 12 months, the average return was in excess of 14%, which is well above average. And more importantly, 100% of those occurrences saw a positive total return over that 1-year horizon. So the market's had an incredible bounce back here since March 23. This data suggests that we're due for a consolidation, which I believe we're in the middle of now. I don't think it's a renewed leg down, but it's a consolidation. But that the outlook, when you look longer term, 1 year out, is still very strong. Another way to show that is to track gains over a time period. This shows the best 50-day gains for the S&P 500. And again, this is coming off the March 23 low. And the current bounce back in terms of gains at 39.6% is the strongest 50-day change off of a low for the stock market ever. So it speaks to this how strong this rebound has been. And similar to the prior table, we look at total returns 1, 3, 6, and 12 months out. And again, the 1 month prospect or return has been not very impressive, just under 1%. But again, here, as you move further out, returns improve. And when you get to the 6 and 12-month returns, they're strongly above average, and the average return, they're 100% positive and strongly above average. So again, this bodes well for longer term returns, but again, tends to support that expectation for some consolidation. I should note it's very much normal. In 2009, as the stock market recovered from the financial crisis of 2008, there was a period in early 2009, from the end of April through mid-July, where the stock market just moved sideways. So a 2-month period where the stock market didn't make much ground. So it is quite normal. There's a lot of historical precedents when you have a strong run-up that the market tends to consolidate, take a breather. There are still risks out there. So again, it's just have that expectation, knowing that I think future improvement is going to be a little choppier and slower to come by. Now, one of the things that so we have a view that if there is a correction or pullback in the market, it is unlikely to go very far. And part of that is just the amount of cash on the sidelines and the pessimism still out there among institutional investors. This chart shows the speculative short positions or big bets on the market to go down. And this acts as a contrarian indicator. It happened in late 2011. In early 2016, and again recently. When you get these big one-sided bets from investors speculating on stock market declines, it's actually a contrarian indicator and provides support for the market for either a rebound or limiting any decline. And in fact, in late 2011, early 2016, that was the start of a leg higher in the equity market. And again, now the big bets on declines in the stock market might be a little bit overdone, and that's going to limit, I think, any decline in the equity market, just because those bets will likely be reversed with any decline. On another way to measure that is institutional investors are defensive across the board. And if you look at their positioning, and B of A Merrill does a fund manager survey every month, and I've circled 3 at the top there: U.S. cash and bonds. Specifically in the cash and bonds are big overweights relative to normal. So it basically shows investors are overweight or focusing on cash and bonds. These are very defensive investments, of course. And then if you look towards the bottom, their equities institutional investors are underweight. So a lot of conservative defensive positioning among institutional investors. And this also is a contrarian indicator. You tend to get the market move the opposite way when investors are offsides a big market move like the recent rebound. So I think if we do get a correction, it's likely to be limited. Maybe it's 10%, could be 15%. But again, I don't see a big decline going back to those March 23 lows, just given the breadth of the move off of the low and also the extraordinary support from central banks and governments around the world. Now, one of the questions I get a lot is, how can the stock market be so resilient when the economic data is so bad? And I think there's one is that the stock market is a forward-looking indicator, but even when we get beyond that, if you look under the hood of the stock market and you look specifically at the 11 sectors that comprise the S&P 500, you'll find really a tale of 2 markets. So this is first quarter earnings growth, profit growth among the 11 sectors. The red groups are fared the worst, and green obviously is better. And you can see that 4 sectors, specifically consumer discretionary, which is where we spend excess money, energy, financials, and industrials, had very, very weak profits for the first quarter, and they're likely to remain weak for the second quarter. But together, they account for 31% of the S&P 500. However, if you look at technology, which actually grew profits, as did communication services, as did healthcare, and you look at consumer staples, which are those necessary items, those four sectors all witness profit growth. And I think that's a little bit of a surprise to many folks. But more importantly, that's 61% of the equity market as measured by the S&P 500 index. So important to realize that under the hood, there are a lot of sectors, a lot of companies still making money despite the pandemic. I think this dynamic will change a little bit in the second quarter. You'll see weaker growth at some of those strong points like consumer staples, tech, and services, but still there's a lot of resilience under the hood, and this helps explain some of the difference in the equity market. So an important fact to keep in mind. One other data point, we looked at all of the employment data, and in April, the employment report was terrible, big job loss, big spike in the unemployment rate. When the unemployment or when jobs decline by more than 200,000 in any given month, and that's happened 43 times since the end of World War II, there has been the subsequent 12-month return in the stock market is on average 17% and positive 83% of the time. And I think that's one metric that shows you how the market anticipates improvement after you've seen the worst in the labor market. So just because data is very, very bad, that's normal. The market tends to react to future improvement. Even the hint of improvement can be enough to spur improvement in the stock market. So important to understand those dynamics that are driving the equity market. Now, a couple points, and one of the risk factors for me for stocks is, well, one thing first, the support for the stock market has also come from the fact that corporate profit forecasts have bottomed out. So the bottom line shows where analysts expect S&P 500 earnings to even out for the year, which would be $127 on the index, and then an improvement to $163 a share on aggregate for the S&P 500 at the end of 2021. That is where earnings finished 2019. So implicit in the equity rebound or stock market rebound is an expectation that both the economy and corporate profits get back to normal by the end of 2021. And you can see that on this next chart here. Now, on the prior chart here, this basically is a key. When those profit estimates flatten out, that usually means the worst is priced in, and that's a key support for the market. However, what I don't think is priced in is this rebound here to 164 in the for 2021, 163 as it changes. This is from FactSet. Basically, to say that rebound's going to happen in 2 years might be a little too early, aggressive in my view. On average, it's taken about 2.75 years for profits to rebound following a recession. In fact, the fastest it's ever happened is 2 years. So I think that's a little aggressive. And as that expectation gets pushed out into 2022, that could be the source of more equity market weakness and also limit potential total returns. But again, I do not see that market going back to the March 23 low. So this is a source of volatility of risk as we move forward. If I turn now to the bond market, lots of improvement there. This is the average high yield spread, or the average yield advantage of high yield bonds relative to treasuries, standing a little over 6%, which is above the long-term average of 5%. You can see how that yield gap has narrowed, which reflects the improvement in high yield bonds. This is I think most of the improvement's done here, but still, if investors need a little extra yield or wanted to play and be a little more conservative rather than buy stocks, I think high yield is a good place to do that. Should be well supported by what the Fed has done, and also some of the better liquidity in that market as well. Yes, defaults will increase in high yield, but I think the improvement here is very forward looking and one area to consider within fixed income markets to boost return. In terms of the high quality bond market, it's important to realize how future return expectations have really changed. Now, we continue to use high quality bonds as a hedge, as protection from equity market weakness, and I think that is still valid. But investors need to know that when you look at a high quality bond instrument, just what your expected returns will be over coming years. And yield is a good predictor of future bond returns. So on the gold line, I've taken the 10-year treasury yield and basically shifted it out 10 years. And then the black line is the Barclays Aggregate Bond Index. It's the S&P 500 of the bond market. It's a broad aggregate measure of bond market performance, and you can see how closely it tracks the yield of the 10-year treasury. So what the 10-year treasury yield is saying currently, but at lower or just at under 1%, is that high quality bond returns will likely drift under 1%. Now, because some of the distortions in the taxable bond market, I think this is probably going to work out to 1 to 2%, but still a big change from sort of the 3 to 4% expectation we had at the beginning of the year on a long-term basis. Now we're looking at 1 to 2%, I think, long-term high-quality bond returns. So from an investor standpoint, important to know that while bonds can still be a good diversifier of risk, that return expectations are likely to be a lot lower. And I think that's accurately reflected in this chart. So we're continuing to look at that as we construct portfolios, but again, a key indicator as we look at bond returns. And then one other point to keep in mind, I went back and looked at all the times the Fed cut rates since the late 80s. And whenever the Fed does cut rates, they tend to stay low for a long period of time. And there's expectation, certainly among our clients, about rates going up. I tend to temper those. I think rates are going to be low for a long time. And if you look at history, the Fed, whenever they've begun to cut rates, they tend to keep those interest rates low for a long period of time. So these are I show the last 5 times the Fed cut rates, when they subsequently raised rates, and how much time passed since then. And on average, the Fed has waited 4 years before they started to raise rates again. And if you go back to the current cycle, which began July of last year, so we're about 1 year in, that would tell you that we've got another 3 years to go before the Fed raises rates. And in fact, the Fed did come out at its most recent meeting in mid-June and said that they don't plan to raise rates through the end of 2022, so 2.5 years from now. So rates aren't going anywhere. They're likely to stay low. We think cash is punitive, and therefore it behooves investors to stick with a diversified investment plan or contribute more to it, as cash is punitive. So if you look at history, the Fed is likely to keep rates low for a very long period of time. And the Fed is still considering additional stimulus, additional measures. If they do that, that could pin interest rates even lower and longer. They're considering yield curve control, which means they may set an explicit target on some short-term yield metrics like the 2-year or 3-year treasury. That would likely keep rates pinned lower as well. So do be aware of that. Those rates are going to stay low for a long period of time. So take that into account in your investment plans. So again, that covers the markets. I want to shift now to some other risks for the broader economy, and one is the virus. So if we look at virus, and certainly if you're following the news, you know that the virus has picked up. This is through June 23rd. In the last few days, new case growth has continued to accelerate in the US. In fact, just yesterday had the biggest single day total, roughly 38,000 new cases. So you're seeing the acceleration in the virus. I don't think we're going to see a broad lockdown like we saw in March, because we do know much more about the virus now. Social distancing has worked, wearing a mask has worked, and we've done a pretty good job of protecting the vulnerable. So the key metric to watch really is the fatality rate, and that has continued to decline even with the increase in cases. Now, this bears watching, since fatalities definitely lag new case growth, so it's something to monitor going forward. So we're really at an inflection point. Over the next 2 weeks, we'll see how much of this case growth translates into a higher fatality rate. If that happens, that could lead to some increase in lockdowns and restrictions. Again, I don't think we'll see the broad, really strict lockdowns of March and April, just because we know how to handle the virus better. But it is something that could retard the economic recovery. And if that happens, you're likely to see continued volatility in financial markets. And another risk to watch for investors, and I think this is a big one, is the election in November. And I'm not making a political statement here when I cover all these aspects, but there's been a pretty dramatic shift since the beginning of June in terms of potential policy change. First is the odds to win the Senate, and Democrats, represented by the black line, In terms of probabilities, and this is from Predictitch, they are expected to take the Senate, which would increase the odds of a Democratic sweep. In recent days, this was through last week, in recent days, the gap has opened up. The probability for the Democrats to take the Senate have actually increased. I should say it's still very early, and any polling data in June has historically not been a great predictor of November. And to that point, when you look at the presidential election, Biden has opened up a fairly substantial lead over President Trump here in the last few weeks. By comparison, in June of 2016, Trump was only a 20% probability to win the election. So a lot can change. It's very early, but I do think that part of the volatility in the stock market, or at least the consolidation that's happened so far in June, is in large part to the market considering policy risk. When you do have a correction in the stock market, it's never one factor like the virus. I think investors thinking about how policy may change as a result of the election is starting to weigh on the mindset. And probably President Biden has proposed a few proposals. Probably the one that has the most impact is higher taxes. President, or the nominee, expected nominee Biden, has at least tempered his proposals. He does, however, still favor an increase in the corporate tax rate to 28%. He also favors a increase in the top tax bracket to 39.6%, not a big move there, and then the potential increase on dividends and capital gains. If there is a broad increase in the corporate tax rate, that is expected to impact corporate profits by about 10 to 20%, which would, I think, at least in the short term, impact the stock market. So these are some of the risks to consider over the next few months in the equity market. I still don't think that takes away from a positive longer term perspective to remain invested, avoid cash, which is punitive. And again, if I just to frame politics, they do have a short-term impact. I am a believer that it's always profits over politics, and in the long run, talking 3-5 years, the party in control of the White House, the party in Congress, has little impact over the trajectory of the stock market, and that's borne out in the economic data, or in the performance data of the stock market. Both Republican and Democratic controlled Congresses or presidencies have witnessed or presided over fairly strong gains, or pretty consistent gains of 9% or more in the equity market. So do keep that in mind on a longer term perspective. Again, this does have a short term impact, but over the long term, it tends to fade away. So just a couple of policy risks to conclude. I want to thank you, everyone, and just again, a reminder, we think the backdrop is good on a longer term 6 to 12 month basis, but we are due for a consolidation and bouts of volatility for some time, given the strength of the rebound. Let me pause there and move to questions.
And you touched on this a little bit, but how do you expect the election to impact the stock market, and when will the market react to the election?
Yeah, so I think the months leading up to the election will be more telling. Historically, that's been the case. In fact, an interesting fact, the S&P in the 3 months leading up to the election, so when you look at August, September, October, the S&P 500 has predicted the election outcome 87% of the time, and that's going back all the way to 1933. So if the stock market is higher in those 3 months, then the incumbent has won. If the stock market was lower, the challenger has won. So it's something to keep in mind. And I think as we get closer to the convention, as we find out who the vice president nominee will be with Biden, as we get to the debates and on street, getting more information about the election, that'll become more clear. So I think the market will give its signal a little more loudly as we get closer to the election. Again, at this point, it's still too early, and historically, you haven't seen a strong correlation to what happens in June and in the election. But as you look at what's the potential outcome, the biggest takeaway, I think, from a potential Biden presidency is an increase in taxes. I also expect the Democrats to launch an infrastructure bill, which might be different than what Republicans would expect. So there could be some impact there in terms of materials companies, industrials benefiting from an infrastructure package. And then there look likely to be some sort of change on the healthcare front, although like his tax proposal, Biden has suggested tempering that down a bit. So whether it's managed care stocks will benefit or other healthcare suppliers. I think there could be still positive implications for segments of the healthcare industry. Wouldn't necessarily be a broad negative for healthcare. So those are the things to watch. I think we'll still early, but that's what I'm watching for regards to the election.
All right, here was a question early on. What is the balance between the lost sales revenue and opening up for business?
The balance between lost sales revenue, I mean, I think if I could frame it in the sense that we haven't seen a recuperation of all, I mean, we've got a long way to go to recover what was lost during the downturn in March. That's going to take some time. And one way to explain it is, if you miss a vacation in 2020, that doesn't mean you're going to take 2 vacations or an extra vacation in 2021. So some of it is permanent, but it's really charting that return to normal. And historically, that return is taking almost 3 years following any recession. And then we are in a recession. I think the worst of it is in April. But that expectation of when we get back to normal, I think, is really the key driver for the stock market. Again, I think the expectation now is it's going to take 2 years, but I think it's going to take longer than that. And that's why I think it'll be a choppy market here for over the next few months.
Let's see, here's another question. When do you think will be the best time to buy a home? Is this a good time to buy or sell a house?
Well, the market's still very strong, and I think if there was an opportunity, it was back in April. Most places in the U.S. still don't have enough supply, and broadly, the U.S. Housing industry never created that supply post 2008. So there's a favorable supply demand dynamic. I don't know if I'd call it a robust housing market, but the data we look at shows a pretty strong bounce back from April. Low interest rates are clearly the biggest driver of that. And at first, you didn't see the drop in interest rates pass through to residential mortgage rates, but you're seeing that in the last several weeks with all-time lows in the 30-year fixed-rate mortgage. So those bottlenecks in the mortgage market that were created as a result of the pandemic have been worked through. So I think you're starting to see a truer representation in terms of mortgage rates. I don't think they'll go lower, but those low rates are really what's driving strength in the residential real estate market, and it looks to stay that way as long as rates are low. It seems like the job market is not going to have maybe the big impact that many thought on the residential real estate market.
What's the long-term impact of China trade deals on U.S. economy?
So in the grander scheme of things, China trade is a small part of the U.S. economy. Call it 0.1, 0.2%. It's that's what it is on an actual number basis. So it is small in the overall scheme of things. By itself, it's not enough to derail the U.S. economy or materially change its longer-term trajectory. Some of the things that are harder to measure are disruptions in the supply chains that lead to other bottlenecks along the way. That's harder to measure, but even in an adverse case there, that's maybe 0.5% of economic growth, which is that's significant, but it's again not going to be a make or break on the U.S. economy. So I think that from an economic endpoint is overstated in my view, and there's going to be other factors that ultimately drive the success of the U.S. economy.
Here's another question here. What's going on with the coin shortage? How is the economy impacted by this? How is the economy impacted by this, if at all?
So I don't think the economy is impacted by it. To be honest, I've just recently learned about the coin shortage at various banks, but I don't see that being a major disruptor, at least at first glance here.
All right, lots of good information here. Let's see, and I'm curious about this one too. What do you read? What are the good publications to read to keep current in the economy? In addition to, of course, the San Diego Union-Tribune.
Sure. So, well, that's a good question. There's a lot to read and comes from a lot of different sources. I have the benefit of having access to Bloomberg. I think that's a real good one on the economy and financial markets. Occasionally, they'll quote some really smart people in the markets, and you can get ideas and a good handle of what's to happen. I think Bloomberg does a good job of framing consensus forecasts as well. I think other publications like the Wall Street Journal, Financial Times, and other, really any kind of financial reporting in the media just I think is helpful. Beyond that, I think there's a lot of public available information. So on the economic data, you can track data by going to specific websites like Econoday for economic data. A lot of the financial news sites have data on stocks and the economy. Even some of the social media sites, Twitter, and you can get some on LinkedIn, some of the fund company websites. You can get a lot of good information via the web relatively free. The real challenge is just processing it all. I mean, everyone has some of the key news information. It's just a matter to process it all. And I think when you go through it enough, be it some of the media or blog sites or social media, you'll find what works and is informative to help you make decisions.
There's another question here. Where is gold going?
Okay, question. That's the one I get a lot. Is should we have gold in our portfolio? And I think near term, the outlook for gold is good. I think it's going to hold on to its gains. It might even increase those. From a longer term investor perspective, that's not something that I historically have been attracted to or want to include in portfolios. And the reason being is gold benefits when rates drop and what we call the inflation adjusted rate drops as well. That's usually the biggest driver of gold. And that's what's happened since the Fed started cutting rates last year. And gold has started to move, and then it picked up steam here in 2020 as the Fed got more aggressive. But most of that is priced in. So much of the benefits there, I think the horse is out of the gate, so to speak. But because rates are going to stay low over the near term, because the fact the Fed has even talked about a cap on short-term interest rates, I think gold is going to be supported over the next few months. Beyond that, from an investment standpoint, gold is one of those things that doesn't produce earnings, it doesn't have a dividend yield, doesn't pay interest. So to frame it into an investment portfolio, I typically don't. It's more of a short-term hedge. If you want to do that, but I don't see a long-term opportunity here.
All right. Your mic was kind of breaking up a little bit. I think we got the gist of what you were saying. We have time for just a couple more questions. For someone who is just starting investing, what advice would you have for them?
Yeah, for someone who's just getting started, get involved. Get started. If you're cautious about the market, take 3 months, maybe 6 months to pick one time a month to invest. Be disciplined. That is something that we have a battle with internally. And if my mic cuts out again, please let me know. I'll be happy to repeat. But even some of our very sophisticated clients went to cash in late March and have done themselves a great disservice. I mean, I'm talking about some business owners, some people with a lot of experience, and they just panic. That's the worst thing you can do. You need to stay with a disciplined investment program. And the reason why is because over time, 3, 5, 7 years, it works. You will have painful 1-year periods, maybe even painful 2-year periods, but over time, it's the best way to grow capital. It's the best way to save money and reach your goals. So I would say, by the way, you hear a lot about dollar cost averaging. The data actually supports that a lump sum investment is better. So if you do have money to put to work, find the strategy you think suits your goals and risk tolerance, and then commit to it. Either invest all of it or pick 6 months and put it to work. And I wouldn't wait too long. The longer you wait, the harder you risk missing out some good days and some gains. And the other caution against timing the market. The last few months have been a perfect example of why you don't time the market. I mean, people panic in March and they expect it to be really bad for a long period of time. Well, what happens? Market completely reverses, and again, I don't think we're going to see those lows again. So it's impossible to do. The pros can't do it. Just again, pick an investment plan, stick with it, and be committed.
Anthony, do you think we will see banks in trouble in about 6 months or so if people start to default, or when they start to default? And do you project high defaults on bank loans?
Good question. I do not expect banks to be in trouble in 6 months, and I know that's been in the news with the Fed stress tests yesterday. If there is one good thing that came out of all the regulation post 2008, it's that banks are on much stronger footing. The one metric to watch there is what we call Tier 1 capital. It is almost double what it was going into 2008. So the banks are on very good footing. I would not be worried about the health of the banks. They can weather the storm. Yes, they'll have increasing loan losses. That's baked into the cake. They've put money aside for that, but I do not see any sort of systemic financial or bank failure coming.
Okay. Final question here. What are the best money moves for investors right now?
The best money moves. I would say with regard to the disciplined investment plan, I would put at the top, but stay diversified. Don't make a big bet. We focus mainly on U.S. stocks. We believe that's the right place to be. So roughly 80% of our equity allocations in U.S. or 75 to 80. Large cap stocks make up the bulk. And we don't try to pick individual stocks. We think that leads to imperfect performance. Again, have that diversified portfolio, and if you can't tolerate the risk, have some bonds. I still think that's okay, but be diversified, and again, just stay invested and committed to the market.
All right. I said one final one. We keep getting them. The bank stock seems like a steal. Do you agree?
If they're a steal, they're certainly cheap. What I think the market is still debating, and for banks, you need a steeper yield curve, and that's basically a bigger interest rate gap between short-term rates and longer-term rates, like the 10-year. But it's likely to remain compressed for some time, especially with the Fed saying they're going to keep short-term rates on hold for a long period of time. So yes, they're cheap. Are they a screaming buy? I would say probably not, but they are cheap. I just don't expect a quick bounce back in the bank stocks, just given the broader macro environment. Now that could change. It depends on the trajectory of the virus, but I think over the near term, no. I think actually we favor growth stocks. I think investors are going to pay for the companies that continue to generate profits, like technology and some of the healthcare sectors.
All right, Anthony, anything else you'd like to add?
Oh, just thanks for having me. And again, to those investors out there, I think the best thing you can do for yourself is, again, stick to that investment plan. Try not to follow all the day-to-day whims, because there's a lot to worry about if you focus on that. Just keep your eyes on the prize and stay long-term.
All right, Anthony, thank you so much for sharing your expertise with us. Thank you, Anthony Valeri, Investment Management Director for Wealth and Fiduciary Services at California Bank and Trust. And thank you to everyone who joined us this
Thanks for having me.
Yeah, our pleasure. Thank you so much for your time. I hope to see you again, everyone, in about 2 weeks when we hold another Free Together San Diego Business webinar. Have a great day and have a great weekend, everybody.